Welcome back. Let's get to our Leslie Picker in Las Vegas this morning. Joining us in a CNBC exclusive with the chairman and CEO of Goldman Sachs, David Solomon, live from the company's Private Innovative Company Conference. Morning, Leslie.
Good morning, CQ. David, thank you so much for doing this.
I'm delighted to be here with you again, Leslie. It's great for you to come back here.
Delighted to be here with you again, too. So as Carl mentioned, we're here at a Private Innovative Companies Conference. So let's start the conversation with the innovative economy, because that has really been in focus for the markets these days. You said in early October that you wouldn't be surprised to see a drawdown in the next year or two, because that's what happens historically with an acceleration in new technology when markets can run ahead of their potential. Given what we've seen over the last few weeks, do you feel like the froth has been fully taken out of the market, or do you think there's still some remnants of it?
Well, first, I just want to say thank you for being here. This is an incredible conference. We have hundreds and hundreds of companies and hundreds of investors that are here to really look at what is the core of the innovative economy, which is new companies and entrepreneurs that are building great companies that ultimately CNBC will talk about 5-10 years from now as they go public, they raise more capital. And so this is really a great event. And I love coming to this event because I really get a chance to meet with so many of these entrepreneurs. And when I think about our economy and what goes on here and why the U.S. is in such a preeminent position, this entrepreneurial innovative economy, which we really have in spades compared to almost any other economy in the world, is really one of the things that makes America so exceptional. So glad to be here, happy to have you. On the bigger hyperscaler AI economy, what I'd say is I'm not surprised there's a little volatility in markets. At the same point, I'll repeat what I've said, constantly about this. I'm super excited about the technology. I think the investments that are being made to set this technology up so it can be deployed in the enterprise is extremely exciting. It's going to create enormous productivity gains in the economy. At the moment, the world is basically looking at all the things that can go right, and they're discounting the things that can go wrong. And they think the pace of adoption on all this infrastructure as it goes into place is going to be really, really quick. I think it's going to come. It's probably going to go a little bit slower. And I think as the market really adjusts to just the pace of adoption and how this capital that's being invested is producing returns, you'll see ups and downs and speed bumps, some drawdowns, some accelerations. And I think that's going to continue for a number of years. But the general direction and the opportunity set and the power of these models, I know that Google just released Gemini 3, yesterday, and what people were saying about that, the power of these models and the ability to ultimately deploy this in the enterprise and really drive huge productivity gains is very exciting, but it's hard to get this stuff deployed. It's hard for companies to underwrite new processes in their organizations. And I think it's going to take some time. And so I'm not surprised by what we're seeing, but I'm still very optimistic.
How does that filter through to some of the concerns around the financing, the pace of adoption, ultimately, hopefully will one day translate into revenue and cash flow that will be used to hopefully pay back some of the debt that's being raised in order to fund some of this. But there are some concerns that the pace of adoption is too slow and that those debt obligations won't ultimately be met. As you talk to clients, as you talk to investors in the markets, is that a valid concern?
Well, when you talk about debt and capital, there are a lot of things that are mixed together. Obviously, the big hyperscalers are big businesses that have enormous cash flow, and there's no question they're taking more of their cash flow and investing it in these projects, but they still have a lot of free cash flow. These are the biggest, most profitable companies in the world, and I think they stand pretty strong to the obligations they're making. When people look at data centers and the financing of data centers, those are like real estate deals. At the end of the day, those are real estate deals. You're putting something in the ground. It's got an outtake. There's debt that has to be serviced in that. It's really about the creditors that are taking, the output of those data centers, and the creditors are really the best, biggest companies in the world. I don't get too concerned about that. Where, I think it gets more complicated is when you're talking about new companies and private capital formation, and there are going to be winners and losers, and that's more risk capital. And there it's harder to predict who the winners and losers will be. But there's a lot of capital being deployed, and there's a difference between capital not getting great returns when big companies deploy it, but they still have lots of cash flow. That ultimately makes their stock go down a little bit. There are also companies where people have real risk capital and trying to create new companies, new businesses, and some of those are going to turn out to be incredibly large, profitable companies, and some of them will go away, just as we've seen in past cycles. And, those things are harder things to judge.
How should we think about the risk there? Because AI has been such a key driver, a key component of everything from productivity to GDP growth. People are calling it deflationary as we're in, kind of period of sticky inflation. If that all reverses, then what happens to the economy?
I don't think it's reversing. Okay, this is a long-term secular trend, and I do think you have to go back and look at other long-term secular trends. They ebb and flow, but the long-term trend's in place. So if you and I are sitting here and asking what's going to happen 15 years from now, I've got a lot of confidence that the economic benefit, the productivity gains from this technology being deployed in enterprises broadly are going to be extraordinary. And that's going to be very, very good for growth in our economy and productivity in our economy. If we start talking about 6-month windows, obviously it can be choppier and there can be bumps and there can be volatility. But everyone likes to. I have a friend that recently was talking about, skeptics seem very smart, but optimists make a lot of money.
Yes.
And, I think it's really important to recognize this as a long-term secular trend. As risk managers, we have to be very focused on short-term risks. And I think that's important. But, a narrative that something like this is going to, in the near term, blow up the economy. I can't obviously say there can't be very, very significant financial issues in the future on a whole range of topics. But in the distribution, it's a small distribution. These are important technologies. We have big, important companies deploying them. And I think the benefit to our economy overall is going to be very significant in the coming years. But there are things that I think are overvalued and more highly valued than I think they should be, and probably won't produce the earnings that some people imagine at the moment. And that's normal in any one of these acceleration cycles.
One of the key areas that's financing a lot of this data center build out has been private credit. It's an area that people in recent weeks, as we kind of think about AI, whether there's a bubble, whether there's not a bubble, whether the debt loads are eye-popping and scary, kind of the role that private credit plays into all of this. And there have been some headlines recently about questions around the marks that private credit managers are taking, whether they're truly reflective of their underlying assets. We reported this morning about Blue Owl terminating the merger of its 2 funds in order to basically appease some of the volatility that and backlash it faced as a result of that. You have a very sizable private credit business at Goldman Sachs. How do you look at all of this, and especially in the context of some of the reputational concerns that are out there right now?
Well, private credit is a very, very big business. Credit is a very, very big business, and Goldman Sachs is an interesting organization in this context because we're one of the few organizations that operates as a bank and as a regulated lender. We also have a big asset management business with a very, very large private credit business. We're also a huge arranger and an intermediary in the formation of credit. We really sit across the spectrum and we see all aspects of the business. I think one of the things that's important to do is make sure we're very clear when we're talking about different things. Private credit is a business, and I thought Craig Packard did a pretty good job today articulating, what goes on in their public funds and their private funds, lends to companies that are important companies in the economy. And they lend to those companies. They are generally below investment grade companies when we're talking about direct lending. And these companies have cash flow and they're big companies. And if the economy's doing well, which, by the way, the economy has been doing well and we haven't had a credit cycle for quite some time, the performance of those portfolios is generally pretty good. When we do have an economic contraction or we do have a recession, you're going to see more difficult performance in those portfolios. That's very different than private credit financing data centers, okay, and capital financing data centers. And again, data centers like real estate deals. Who is the end takeoff, provider? So if you're relying on some of this data center financing on people like Google or Meta or Amazon, okay, that's very different than if you're relying, on a company with different credit standards. So these are all different aspects of lending. They're all different. The credit risks are different. One of the things I've said about credit generally is it's a process business. Your underwriting standards, how you manage risk, how you run your underwriting processes, how you manage your portfolio, very, very important. And I think there are people that are very, very good at it. And of course, when we have an economic recession or we have a contraction, you're going to see who's better at it and who's worse. We spend a lot of time on this because we've been doing this for 40 years. So we've been in these businesses for a long, long time. But I think discipline, risk management, very, very important in these businesses. But it's hard to see where the real issues are until you have a real credit contraction from a recession or an economic slowdown. We don't have that at the moment.
Yeah.